Howdy, Team 42. It's your skipper here, Darius Delta, presenting another fantastic episode of Pro to Pro Live. I'm joined by a friend, Nadine Terman, founder and CEO of Solstein Capital. Nadine's one of my favorite people, one of the best investors I've come across in the world, one of the smartest people working in the institutional finance biz, having been trained in math at Stanford. So we're really delighted to have her back on the program. How are you doing today, Nadine?
Good, as always. This is always fun. So I love reading through your materials, see where we overlap. This is going to be a fun time.
Yeah, it's always a good time. I appreciate it. So the reason we have Nadine on the show today is because Nadine does something that I think the world's best investors do, which is have a macro overlay on top of a micro framework. Nadine, you manage, I want to say close to $1 billion in assets for clients and families all over around the world. With a two-pronged investment approach. Obviously, you have a top-down view on where the world's likely headed and where the dispersion is likely to lie across geographies. And then you obviously have an analyst team that is busy generating actionable investment ideas to pair up with those macro themes. So I wanted to do something fun today, which is go through our macro themes and then hear you pitch a stock that may correspond to each one of those themes. Is that something that works for you?
Yeah, and some of it will be stocks, some of it will be like how I would go about to trade that idea, if that makes
Yep.
sense. So people
Sounds
kind of
good.
put their own spin on it. Everyone's got their own, I guess, investment process or boundaries in terms of risk and the return they're looking for. But I'm going to address it in the terms of like, how would I play it?
I love it. I love it. So let's just hop right into it without further delay. So on the slides on the screen here, we just have our fundamental research summary updated for today. These themes are in order of when we introduce them to clients and the associated conviction with those themes. We currently have high conviction in each of the four themes. The first theme being sticky inflation. We have a view that U.S. inflation is unlikely to durably return to the Fed's stated 2% and de facto 2.5% targets in the absence of a recession. Inflation is likely bottomed in sequential terms and is likely to meander higher over the next year. Upside surprises in inflation are unlikely to cause problems for asset markets until the Fed downgrades its labor market in its reaction function, which it may not occur until economic resiliency is confirmed by the data well into 2025. So how are you thinking about playing that at the current juncture, Nadine?
Sure. And I think, so I want to say that I agree in this thesis, right?
Ooh, that's
So
awesome.
the number one thing is I agree in this, but then the question is, what do you do about it? Which I'm going to say, I'm going to play against it. And that
Ooh.
for in a bit, right? Which is like, so what do people need to do? You don't get paid for being right. You get paid for making money.
Yep.
So I think that there's a time frame to support this thesis with the positions you have. And then there's a time frame where you want to be going against it. And so what do I mean by that? And I'll show you a chart in a second. But it's not out yet. We just recorded it, so we're editing it. It's a podcast with Q Hendry, who's the asset capitalist. And what part of the discussion, it's not, I mean, yes, it's part of this, but it was like this debate, and I loved it because off the bat, he was like, all right, you're wrong on something, right? Is when I said, we like to be non-consensus and not following the trend. But then he came back and agreed with me, and it's about the timing of when you play something. So what's priced in, what is possible or likely, and then so a question is, could Goldilocks like be self-defeating here, right?
Mm.
So
Mm.
if we turn to the chart that I told you I was gonna like pick up first, right? So is Goldilocks priced in? And
So
so if
what?
it is highly priced in, you can still probably make money, like thinking certain things like, well, you're not going to get maybe Goldilocks down to 2, but it's not going to be so bad that people are going to be upset and growth's going to be okay. But maybe the tails, the barbells are cheap. So can
Yeah.
we put on some trades, because that's what it is, it's trades. These aren't, individual stocks always, but are there trades or basket of securities that we can put in here that could be priced more asymmetrically for us, so that if this probable scenario that you're pointing out doesn't come to happen, you could be paid handsomely, right?
Love it.
And
Love
so
it.
you'd be looking for that cheap way to play deflation or reflation in many ways, right? Um,
Absolutely.
and so what I love what you do is like you keep playing until there's disconfirming signs, so that the people watching are going to make this turn, right? I have a high probability scenario they will listen to you and make this turn and hopefully get ahead of that turn because you're going to be picking up on things. But you might want to, if you can put a trade on, is get like, you can pay for something cheap now so that, if and when it turns, like, you could get paid handsomely on that barbell that is less likely, but you can make some decent money on.
100%. So walk me through this. By the way, I completely agree with everything you're saying. You're talking about institutional portfolio construction, which is something that I think a lot of the world's best investors do, which is not have their entire portfolio sort of built on top of one thing. One thing we try to do for our clients who are generally speaking probably shorter term in nature, talking about hedge funds, even the more actively managed mutual funds, and then obviously retail traders, we're hyper focused on respecting the evolution of the market regime. That's how we generate value for our clients, but that's not how everyone does it. And so there are other investors who construct portfolios based on what their modal outcome view is, and then they construct various scenarios, various baskets, or various trades to help them risk manage the tails. And what you're effectively saying is that the tail associated with reflation or inflation, either or, both will be inflationary, is poorly priced, as evidenced by this current chart here. So what is this chart showing us, and sort of how are we supposed to interpret
Yeah,
this?
so it's basically saying, if you're looking at the red circle, market's not expecting inflation. So certainly it's, given the print this morning, you could argue how much is related to Boeing and hurricanes and the like, is that we're not going to 2. Like that's what it's showing us, just like you're saying. But what if the scenario of war, of some of these issues, what if, whoever comes into power here in the US in the fourth quarter, what if you did swing to, 5% or super low? Like, what if you hit those tails of this versus being in the sweet spot of like chopping around, like you're saying? Then, well, what would happen? Well, obviously, nobody's looking for that scenario because it's not likely. But that's often where, if there's like a risk budget, or I call it a sandbox. So I call it a sandbox, what you can play with, where there's this part of your portfolio where you could, it's like, going to the dollar store. And so buying something at Target in the dollar bin is like a super quality thing right now. No, but it brings like a lot of joy to your kid. So I can pay a really small amount of money for like a ton of potential joy for a child. And that's
Totally.
kind of how I think about this for your portfolio, is that no one's really betting on this. So you could be picking up some of these interesting trades, right? That if it did, and I'm not saying that's going to come to pass in the next month. So you have to be able to take a look out further. So depending what you can trade, is it stocks, is it credit, is it options, is it futures? So you're going to have to figure out what that means for you. But if you add a lot more inflation, or a lot less, what is being mispriced today? Because everybody was believing in the soft landing.
100%. I mean, look, we're essentially 85% in terms of the probability of a soft landing, as evidenced by the SOFR, the probability of the SOFR in June 2025 being somewhere between 5.25% and 3%. And so in our opinion, that's essentially saying the market already agrees with our now casted view of Goldilocks. The market agrees with our general fundamental view of Goldilocks as well, when you layer on the rest of the themes, which we'll talk about subsequently. And so you're essentially saying there's a real kind of high probability chance of, potentially making money. Your downside is very capped from this starting point if you put on inflationary trades.
So is it going to happen to make money on some of these trades? Probably not, right? Because that's not in your favor. But if it did, you're going to get paid a lot because no one's caring about it.
Well, I'll show you something today. So this week has been a very interesting week in the context of our core risk management signaling. So as you know, Nadine, we use our discretionary risk management overlay, aka Dr. Mo, to help clients time and size positions on factor long short bets. And just today, while we're talking, having this conversation, commodities broke out to a long max position in terms of Dr. Mo's proper trade recommendation. Crude oil broke out to a long half position. Uranium broke out to a long max position. And then earlier this week, we had energy break out to a long max position. So you think about what the newest change in signals have been in the context of our global risk management system. It's been the inflationary aspects of the market, both in commodities and stocks. So in our opinion, those are the types of trades that have legs in the context of the overall probability of the inflation tail being mispriced currently.
Yeah, and so maybe you can create a basket that it doesn't have to, you don't have to have the exact idea of where inflation will be. It's just going to be higher than what other people think.
100%.
Right? And so when you're making these trades, that's how I would like to think about it, is like, where is nobody looking? What's everybody kind of leaving to the side of not likely? And then, because at one point, remember, the Mag 7 could not go down, but that's not been a great trade since July 10th. And so thinking through where everybody else is, so can you pick up, some cheap stuff where people aren't playing?
Yeah, 100%, 100%. You said one final thing that I think it's important to unpack. We're not, with the context of our grid model projection. So, our core, one of our core fundamental themes is that nominal GDP will continue to surprise to the upside. If you look at real economic growth, we are still the high on the street with respect to real economic growth. We have been for 2 years now, over 2 years now. And then with respect to inflation, our inflation forecasts are to diverge from consensus, kind of as we get later into the fourth quarter. And as you can see, the spread between the blue line and the red line, that's us versus Bloomberg consensus, that spread starts to grow as we progress throughout 2025. So we, going back to these signals we just highlighted with respect to our discretionary risk management overlay, those breakouts could be the very beginning of what could potentially be a multi-quarter trend of commodity type of performance and the outperformance of, energy and raw materials producers, so that the investors should be aware of that.
Exactly. So I have confidence you're going to get people there. But I always take a look at themes, but then also like, well, where's everybody else at? And so that in the context of that, your signals are great because it'll help people maybe drive to. So an example is that we are reinvestigating where we can play actually in these areas. So this has been a work for us for a few weeks now. Because sometimes you have long only accounts. So we have, hedged accounts and some long only institutional accounts that you're not allowed to, for, ESG or other reasons, play in these areas. But there are some securities that you actually can get. Maybe they're lower market cap or other things. So we're kind of looking layer under layer where, people haven't been allowed to play in some of this. People haven't been in it, even if they can trade in it. So you might get a double benefit. When people are realizing, gosh, we need to get this more in our portfolio. And if you can't go into some of the big common ones, maybe they'll be picking up some smaller, more less known names. So that's a little tidbit for you. So this is literally a call like 2 hours ago with my team. And so we've been researching that. Yeah.
Look, that's a fun project to research. Okay, I can't be long energy because of ESG. So now I have to find proxies for energy, right?
Yeah, or things that are related to the energy space or are energy companies, but just aren't banned because maybe they didn't make the radar or have two parts of their business. So they're technically called a different, in a different sector. So you can find those types of opportunities.
Gotcha. Yeah, I'm thinking of, I forget the name of the company, but one of my former colleagues was really bullish on a company that sold, I want to say, water to companies in the energy patch.
Yeah.
I was like, I didn't know they bought a bunch of water. That's interesting. Some things like that. Yeah.
Exactly.
Types of derivative plays. And then obviously uranium, in my opinion, I feel like that's something that should meet the hurdle that passed the muster of ESG smell test, which obviously, in our opinion, is likely to trade alongside something like crude oil. Sure. When crude oil breaks out, obviously the allure of the energy transition gets higher and higher in the minds of investors. And so those are the types of plays that folks will rotate into if you start to see more bullish momentum in things like crude oil and other commodities.
Right.
All right, that was fun. All right, let's keep moving here. That's
You're like, I don't know where this is going.
No, this is fantastic. I love doing this. This is awesome. So we're moving to the next theme. So we tackle sticky inflation. Next theme is our resilient U.S. economy theme. We authored that in September of 2022. Maintain high conviction in that. The theme is as follows. So the U.S. economy remains resilient due to historically strong private sector balance sheets, the West Village Montauk effect, limited exposure to the policy rate, limited exposure to the more cyclical manufacturing sector, labor hoarding, and easy financial conditions. We believe growth is likely to continue to surprise to the upside over the medium term. Growth is, however, likely to slow over the medium term due to the ongoing retrenchment among low-income consumers and small businesses, the both of which are far more sensitive to the level of the policy rate than the median household or median enterprise. Talk to me about a positioning for the economy remaining resilient.
Yeah. So again, I want to look to what people aren't pricing in. So what kind of hedges or idiosyncratic opportunities, and then how long, because you've been right on this, right, is do you let those core positions ride for the resilient U.S. economy? And do you play international over U.S.? If so, where do you play? Nothing's been as apparent as China, like the volatility on Chinese positions, right? But let's put that aside for a second. But even here in the U.S., you can have periods where the economy is okay, but asset prices come down. And so why? Well, money flows from one place to another, just as we've seen in tech since July, the big 7 and alike, is this money can flow depending on, what people want to play, why they're playing it, US to Japan, maybe for higher rates, that again, like the bounce back in China. Although I will say, I mean, GS coming with like after the big bounce up, hey, it's going to go up a ton more. And was it 24 or 48 hours that they were
classic,
like basically smashed? Anyways, so you don't want to be chasing things. Again, you want to be finding, well, what could happen? What's possible? And because assets are collateral for leverage, right? So the one thing, the thing that I would think about here, and fiscal impulses really pump things up. So if folks have to address their leverage, and folks could be banks, folks could be consumers, then they look to their assets to say, well, what can I do with them, right? And so you want to be finding, obviously, on the long side where you don't have those problems. Or you want to find or maybe everyone thinks it's going to be terrible, and then it's going to be better than people expect because they're misunderstanding the risk of something that's already been hit on that. But then you also, could look to the other side as if, maybe if people are underestimating leverage in a system, then maybe they're overestimating the stickiness of asset values, right?
Yeah,
Is
totally.
because, you look at how much that they've ridden up. If you ever need to be getting to take care of margin calls, just like you saw in China, or obviously the yen carry trade, what happens when you're on the wrong side of a trade and have leverage? Well, not good things, right? Like
Bad things, very bad
bad
things.
things happen, and they can happen fast. Like you don't have time to like sit there and do your work and go react. And so what I would say to people is maybe do your work earlier on the areas of leverage, and maybe it is banks with their munis, and maybe or with their real estate holdings. Maybe it is consumers, and you think they have cash in their pocket, but just like you saw in China, people thought stimulus was going to make these people spend on holiday, and I think the stats so far is like, like they're keeping the cash, right? Like that's not moving. So understanding where money will flow and why, and if somebody does have to tap those asset values, then are those in your portfolio? Because then you're going to want to trim, or is there a way you could play that on a short way? So I'm not going to name the names of the individual securities, but we've been working on shorting some individual financial stocks where people, we think, don't understand the risk in their system. And then maybe going long preferreds or picking up credit. Like, so having kind of paired trades where one security, you don't have to get the whole thing right on timing, but one security related to either the sector or that individual company could do better than another security if we're right on some of the risks that might not be appreciated. And so when I think about the resilient US economy, I mean, I think you're right. And so, but I think people are there, right?
They are.
And so it's understanding if things aren't as resilient, or even in a resilient economy, what could go wrong, right? And so if things could go wrong, then those different securities will be overly penalized because people are going to say, well, gosh, like, labor's not so bad right now and the economy's humming. And so why do you have so many problems? Why does that stock have so many? You look at Boeing, it's like they keep having more problems and problems. Like you don't want to be coming out and having to have problems during a time when you shouldn't have problems.
100%. We are in a Goldilocks market regime at the, want to say, the 45th all-time high in the S&P 500 in the year to date. We're obviously, or not obviously, I think there's an open debate about where we are in the business cycle expansion. I would argue we're probably not as late cycle as most investors believe we are. But just in the context of us not being early cycle, we are not coming out of a recession. We are not, so being this sort of late into an economic expansion in a Goldilocks market regime should feel weird. And it should make people uncomfortable taking a tremendous amount of risk, which is what a Goldilocks market regime forces you to do as an investor if you're going to remain gainfully employed on the buy side, which is to take a lot of risk. And so in the context of that, we've seen, going back to the smackdown we saw in early August, we told investors to buy the dip. We told investors to buy the dip we saw in early September. Where is the sort of at this level of pricing, again, going back to this awesome chart you showed where the SOFR curve tails are priced, it clearly suggests that, we're probably at this sort of threshold of the amount of Goldilocks that can be priced in. So the next move is either going to be a correction into hard landing fears, i.e. we have some labor data or some other data that gets investors concerned about the sustainability of the Goldilocks market regime, or we have a correction based on inflation fears, i.e. we have a, kind of a mini repeat of something that looks like 2022. So are the trades you sort of highlighted where you're shorting the common stock of the bank and long the preferreds, do they favor any one of those two scenarios?
That would be if the risk is going to get mispriced in that security, the equity's going down. I'd say that the inflation's probably stickier than expected in that scenario. But I don't need to be one way, or I don't have to actually even make your two calls wrong. It just has to be the current risk that they've been taking gets found out.
Oh, interesting. That's sexy, for lack of a better
I
word.
mean?
I like that. Yeah, totally.
So that but then it gets to timing, it gets to, if you're right, but if no one's pricing it in, then you're not paying for that right now. So you just have to look at the opposite side of that. Well, could things keep humming along really well for a while, and what is priced otherwise? And so if you can find those securities where people just have they're just thinking a lot's going to go well, like, oh, the Fed's going to cut, and therefore it's going to help out, these organizations, and they're going to have better situation, whether it's on the credits that they have embedded in their portfolios, or like, so you want to find something where just people aren't as worried, or just think it's gonna work itself out. And so therefore I don't have to make a call where you need to be wrong. You can be right and I can be right. That's like the Goldilocks trade, right? If you want to call it, is like we can both be right and make money on that.
100%. That's some real institutional thinking there, Nadine. I love it. All right, so let's shift gears to our third theme here. Jay wants a soft landing. We authored that at the beginning of November of last year. Maintain high conviction in that. The Fed has an asymmetrically dovish reaction function that is geared towards engineering a soft landing in the U.S. economy. The Fed is implementing its typical fourth turning playbook, which is to kowtow to fiscal dominance by artificially inflating demand for U.S. treasuries amid above target inflation and explosive growth in federal debt. That's a lot. Sounds very, it sounds inflationary, but it also sounds asset price inflationary. So any pushback there, or how would you be structuring trades to take advantage of this thing?
Well, it's funny because like somebody brought up today, and I fought against it a little bit. It's just, what if the Republicans win and Musk gets like, and they're going to be chopping, spend because it's out of control. I don't know any government. This is like an apolitical statement. Like there might be headlines on that, but there's a ton of career risk in actually going after the spend, right? And so I think you can micromanage some spend that you find is out of control, but both parties are expected to spend a lot. So no one's really got a plan to cut debt, right? So I want to say that in this context, right? And so if that's happening, then you've got the Fed. It does affect the Fed, right? Go ahead.
No, I'm actually
looking. Got a chart up, so let's see this.
No, I'm actually looking. The general budget, which I assume is the kind of wasteful spending that Elon Musk will cut, is less than 1% of the total federal expenditures. I mean, he would have to start taking a knife to things that Americans hold near and dear, like Social Security, national defense, Medicare, Medicaid, all those types of things, which very clearly will get you booted off the island really quickly.
Yeah, exactly. You're going to have people in the street. So I didn't have that chart in hand, but it goes to what I'm saying. So when I think about your points about the Fed and points about soft landing, I think of it in the context of what people are expecting in the near term. And so depending on their political bias, or if they're just watching the data and trying to make a trade on it, right? I think the place to make money here is that if you saw like people really betting for one candidate or the other, that would affect the estimation of a possibility for soft landing versus, in that case, if they could save on debt, it all goes together, right? Like I view this as a way to say, well, maybe that would give you an opportunity near term that you should totally trade short term, because I think people will quickly realize that any kind of shaking of the tree, that they're going to cut a lot anywhere, is just not going to happen. I'd trade that, right?
100%.
Because
Yeah, I mean, that's been
that
our
gives
view.
you like that's certainly going to reprice some kind of soft landing scenario, because it means that they're not going to be paying on the same kind of interest. People will look ahead, right? They're going to like reprice and do like a DCF. And so what does that mean today? Like they're going to use headlines to do that math. And so that's, I think, the trade that you're looking for.
Yeah, 100%. I mean, look, we've been, in our view, humbly, on the right side of a lot of the market risks since we authored that theme last November. And sort of the key takeaway is that this is a Federal Reserve that has an asymmetrically dovish reaction function.
Yes.
The incoming data, irrespective of how the data lands from a absolute signaling standpoint, they are more biased to ease as a function of the data, no matter what the data is.
Yeah.
And as a function of that, we probably have an economy that is likely to remain more resilient for longer than the average investor realizes, which ultimately, in our opinion, is more negative for the bond market than it is positive for risk. It's positive for risk assets and it's negative for the bond market. I think when you get to the end of that rainbow, it's probably more negative for the bond market than it is positive for risk assets. But I don't know if we're done with the positive for risk assets portion of the program.
Right.
So this is something we called out back at the year-to-date high in TLT last month when saying, hey, we think we may have seen the top in bonds already in the context of what was already priced into the forward rate curve. Go back then, you had the money market curve. So this is 24, 25, and 26, and then the long run estimates. Right now, what the markets are currently pricing in for the end of 2025, both the Fed and the markets on top of each other in pricing in an additional 150 basis points of rate cuts from now to then. So essentially getting from 4% to 3.5%. We don't think that either of those, the market or the Fed, are correct on that assessment currently. And we ultimately think the Fed at most is probably going to be able to sneak in another roughly 100 basis points of rate cuts, mechanical rate cuts between now and March. And so you're talking about another 50 basis points that's got to come out of money market pricing between now and let's call it, the middle of next year. And then obviously the Fed itself has to revise its dot plot, both in terms of where we are for 2025 and 2026. But it was something we've been arguing since, the summer of 2022 in the context of our resilient U.S. economy theme is a neutral rate as low as they think it is? And if the neutral rate is not as low as they think it is, any further easing may almost risk tilting the federal funds rate into a actually dovish bias, into an unrestrictive setting, into a stimulative setting. And let's say the 4% is the neutral rate, and if they cut below 4%, then you're talking about stimulating the economy and perpetuating an upside, persistent upside surprises in nominal GDP relative to what we already have. And so, in our opinion, we think that duration is probably the biggest risk in asset markets right now, which at some point in the next few quarters, it may cause more broad risk in asset markets, including in stocks and other assets.
And but let's take the opposite of that. What if the Fed kept cutting a lot, right? Not just like, 50, 100 basis points. What if they cut a lot? Like that's not going to go well either, right? Because
100%.
you might see a pop in risk assets, but then you might people going like, what? Why is this happening? Like, who is calling on them to be doing this?
Yeah.
And so not 100%. To be a conspiracy theorist, but I'd be watching banks. I'd be, I think JP Morgan's out tomorrow. I'd be watching all of these groups and saying, does all this make sense? Like, are the stories fitting together? What are their incentives? What's in their balance sheets? And certainly, I don't think you have to be putting on some of these trades now. And I think you are right in what you're saying is that what's the most likely scenario. But again, I'm looking kind of to the barbell. Like no one's expecting rates to go down super low from here. I think everyone thinks it's in this band, the band of soft landing, the band of, things maybe could pop up here or there, but they'll probably soften a little bit. But what if rates went really high? And what if rates went really low? And so I would just kind of ask people, if nobody's thinking it could happen, it might be worth flyers if that's what they do. That's all.
I mean, if you banana to my head, I think the rates, ratcheting higher from here. I think the next 100 basis point move in rates has a higher probability of being higher than lower from here.
Right.
If you think about in the context of our, our core fundamental biases, if you look at the, this is one of my favorite analysis that I've done in recent months, which is trying to figure out, okay, what's the real price of the treasury yield, because we know we have a tremendous amount of financial repression that is accumulated in this post-crisis, post-GFC era. Term premium currently right now are essentially zero on the 10-year relative to the ACM model, and historically term premium have been around 150 basis points on the 10-year. And so, we sort of created a adjusted 10-year treasury yield that we're using now to sort of model things like break-even inflation rates, what the slope of the yield curve is. And the reality is this is an economy that just looks a lot hotter from that perspective than what's currently being signaled by the nominal bond market as a function of the depressed term premium. So if you look at the 10-year nominal treasury yield today, we're at 4.08%. If you add back that 150 basis points of roughly 148 basis points of term premium, you're talking about a 10-year treasury yield of 5.55%. So then if we have a 10-year treasury yield that's that high, then the TIPS break-even rate, which is obviously the nominal yield minus the inflation-adjusted yield, the TIPS break-even rate goes from 2.31% to 3.79%, which is more in line with sort of, kind of the thought process around a fourth turning, which has historically seen significantly higher levels of inflation, significantly higher levels of monetary growth, and significantly deeper devaluations of currency. So those are the kinds of dynamics you would expect in a fourth turning. And this is something that if you remove the term premium, the depressed term premium from the bond market, then that's the kind of take on inflation you'd have. And then finally, if you look at the slope of the 3-month 10-year treasury yield curve, which continues to remain inverted at 56 basis points, the inversion would have gone away, a couple of years ago, and it's currently at plus 91 basis points in terms of a positively sloped yield curve. It's not, extremely positively sloped, but it is still positively sloped, and something that's not necessarily signaling of a recession, near-term recession, which is something we've been arguing for 2 years now. So, I think this is a great analysis in the context of, the asymmetrically dovish, Fed creating outcomes in the economy that, in our opinion, are generally mispriced in the bond market, partially as a function of their asymmetrically dovish policy.
Yeah, can't argue.
Awesome. All right, and then let's do our final theme here. Let me go find our final theme.
The dollar and liquidity.
Yeah, here comes the liquidity. So here comes the liquidity is the thing we authored in September of this year that we have high conviction in that. So the weak U.S. dollar should accelerate global dollar recycling and provide Chinese authorities scope to accelerate support of their economy with fiscal and monetary stimulus to counter the development of a balance sheet recession akin to 1990s Japan. So the China part of that was formerly from our China front-loading stimulus theme, which we authored December of last year. So we kind of rolled that into our Here Comes the Liquidity theme. And obviously China was the largest, kind of major monetary and fiscal authority to come out with big bang stimulus on the other side of the Fed's 50 basis point rate cuts. The U.S. fiscal impulse and Treasury's net financing policy are getting incrementally positive in Q4 ahead of a potential $700 billion spin down of the Treasury general account in Q1. The Fed may slow the pace of fake QT in the coming months too if economic support for rate cuts wanes. So they're going to get their soft landing, whether they do it with rate cuts or whether they do it with slowing the pace of quantitative tightening. And I think investors need to be aware of those potential upside risks to both the economy and asset markets. What are your thoughts on playing that?
I would separate the dollar from what you're saying there, in that I believe over time you'll see a secular trend in the dollar. There's lots of reasons we can kind of go into it.
Secular uptrend or downtrend?
I think the dollar can go down, right? I think
we agree. Yeah, we agree.
can depreciate, but I don't think that's short term. So I think that you could have a sticky, strong dollar for a while. That's what we've been telling our investors, is you got to be a little bit careful on that, on the timing of that play, because if you're going to play that, then you're looking, is it emerging market, local currency bonds? Is it just EM in general? Like, who benefits when the dollar's down? Are there countries? Are there sectors? So there's like a whole playbook you can kind of come up with, if you think about like, why is the dollar going down potentially, and what would you do about in your portfolio? But given the geopolitical risks and given other reasons, we just think you could see this sticky here for a little while. And so we haven't gone whole hog into that play yet. And I'd argue, obviously, that the China bounce back was not related to the dollar. It was related to their potential policies or announcements of the policies. And so I want to separate out the plays you would make on a dollar declining over time versus why they're doing it. Because what arguably as a portfolio manager, you don't want, it's like, I have 10 positions and they all depend on the dollar going down, but it's just the dollar going down, not, why did the dollar go down? So you kind of want things to be based on, for not just like one reason, but a few reasons. So, so if it does go down, you might make more money or have a greater chance to be right, you know? Like in the case of like China, right? Like maybe the dollar isn't what did it, but you also had the idea, well, nobody else was in it, right? And everybody, like whether it's institutions or retail, like, you know, and geopolitically wasn't loved. And so when something is so unloved, like, is it worth a flyer in your portfolio on an absolute basis and or even on a relative if you're playing against a benchmark that has it, right? Like how many people now at the end of September have to look at their portfolios and see what happened to their China, Hong Kong, and other security-related exposures that benefit from China to say, uh-oh, I was underweight for so long, and that's one way I outperformed, and then I'm not now, right? And so when I'd say that, like, while I agree that some of this may be related, you can make bets that are taking apart the liquidity from the dollar aspect to it, right? And that's what I think that we do in our portfolio that I would stress for people to do. But then the liquidity point is very valid of what you're saying. And I think that you're right in that they're tightly managing things. And so I wouldn't fight against them, especially in the short term. But I think that one of the few things they have left now is to lower rates. And so I think you're going to see them be flexing that muscle.
Yeah, 100%. You know, I mean, we certainly have a view that's a little counter to yours. You know, we think this is all about the dollar, in our opinion, very similar to what we saw in the early 2016 period with the last, what we consider to be the Shanghai Accord. If you go, I don't have the chart in this particular deck, but we have a chart that shows the PBOC's growth of the PBOC's balance sheet and the share of the PBOC's balance sheet. In fact, I think I can pull up on my Bloomberg. Let me see if I can pull that up. The growth of the PBOC's balance sheet relative to the share of the balance sheet that is allocated to FX reserves. And what we found is that, you know, ever since the yuan got really strong back in early 2015, ever since that point on a real rare basis, where we show here this middle panel of the rear, the real effective exchange rate of the yuan, because it was in this managed float, tight, narrow range with the very rapidly strengthening US dollar off of its 2011 lows, it effectively broke the China export model. You know, China's currency got so expensive on a rear basis that companies started, you know, they stopped, you know, allocating, you know, FDI resources into China to deepen their install base with the manufacturing sector. And so ever since then, you've seen the share of FX reserves, which is the black line here in the top panel, as PBOC's balance sheet decline precipitously. It peaked at somewhere around 83%. Now it's only at 50%. And as a function of that, or what was really been driving that is the fact that, Chinese corporates have kept a lot of their earnings retained abroad. Ever since the peak of the yuan in real terms in 2015, we've had a persistent capital outflow story in an economy that allegedly has a closed capital count. So how the only way you can actually have capital outflows in China are primary large-scale capital outflows like the kind we're currently seeing is the fact that Chinese corporates, when they sell goods abroad, they don't repatriate the money because they're concerned about a yuan devaluation and have been concerned about a yuan devaluation for the past 9 years. And so the dollar declining, or not the dollar itself, but the Federal Reserve essentially saying we are no longer maintaining a tight monetary policy, we're going to move to a neutral setting, as obviously evidenced by the 50 basis point rate cut. In our opinion, that was a signal to not only Chinese policymakers, but to Chinese corporations that, okay, we don't have to be concerned as much as we have been over a significant devaluation in the yuan. And if you don't have to be concerned about a significant devaluation in yuan, then that means you can step on the monetary gas and grow the monetary base much faster than they currently have been. And so it's all kind of part and parcel. It's all kind of linked in our opinion.
And then you also have on top of that, like I mean, you probably talked about it and read about it. It's just like, given what people saw with Russia and how the US and other countries then tried to control, like, you know, hit them with the stick for bad behavior and the like, and whether with trade or currency or like, they have all incentives with Brazil and other countries to be trading, you know, bartering goods, using crypto, other currencies. So that you have this natural secular trend where people don't want to trade in the dollar. Certain markets have to be priced in dollar and you have to trade in dollar. But if they can, they're going to be moving away from that because they don't ever, if they may have a bad action, they want to, just like you wouldn't want to have some overbearing, you know, parent or regulatory body, you know, telling you what to do. They don't want that. And
100%.
so we view it too as that you have this natural headwind at looking at the dollar, whereas people, if they can not use it, they don't want to.
Agreed.
If they can
Agreed.
find a way to get around it, they're going to do that.
Totally. Dollars, we're bullies. We're bullies. There's no other way to say it in terms of how we've, not we, but the U.S. government has flexed this, sort of economic muscle in recent years.
Right.
If you look, and they're taking advantage of this chart here on slide 49, where we show dollar share of the world total for all these various very important categories in global finance. The dollar is 50% of the anchor currencies for the world, that in GDP terms, that for all the currencies that are pegged with another currency. It's 60% of global FX reserves. It's 60% of cross-border bank lending, 70% of the international debt bond market. It's 79% of trade invoicing, 88% of foreign exchange transactions, and 99% of stablecoin backings. So to your point, these numbers are all probably going to go down over time.
Yeah,
now, they're not going to go down.
No government looks at that and says, I'm comfortable with that.
Well, they're not only
other than ours, right?
Well, exactly. No
other than ours, nobody else says that. Like, oh, I like that. Everyone's like, well, what can I do to get around that?
100%. So, the dollar's at a very asymmetric point right now. If you look at it through the lens of real effective exchange rates, where we show in this chart, it's the red line in this top panel is the dollar's real effective exchange rate. It's as strong as it's ever been. I mean, we only have data in this time series going back to 1995, but you got to go back to the just before the Plaza Accord in the 1980s to see a dollar this strong on a real effective exchange rate basis, most likely. And so if that's the case, then we would argue there's probably nothing but downside from here in the dollar. And the only thing that's going to control the pace of that decline are twofold. One, how fast is the Fed lowering the interest rate advantage that we currently have versus peer currencies? And two, how fast do peer economies start to accelerate and increase the supply and demand of global dollar financing, which ultimately pushes the dollar down lower in price as well. So, those two things, in our opinion, could be a 2025 story, particularly if China continues to feel confident enough to step on the stimulus gas. And obviously on Saturday morning, we're going to get their next batch of fiscal stimulus updates from the Ministry of Finance.
Yeah. So I'm just, the timing of it is the thing that I find hard. So I believe in time the dollar will go down, but we've just been warning to our clients that we're not making trades on that now.
Gotcha. Yep. Yeah. No. So to be clear, we're not making trades on our views on the dollar at all. Our trades all come from our market regime nowcasting.
Sure. Yeah, but you asked for me, and it's
the dollar now.
Like, what do I believe? But until our view is that more short term, you could see the dollar sticky. So it was just premature, because being too premature in my seat is just wrong, and you don't want to be wrong. So you can, you can get that thesis right, but you have to have the timing, you have the symmetry, you got to make money. Like I said at the beginning, all goes back to the end of the day, you got to make money. And so
100%.
You have to have your theses, and you have to have what you do is the data-driven backing of that. But then you also have to see, well, where is everybody else playing? And therefore, like, when's the right time for you? And I just haven't gotten excited enough yet to play this one.
Yeah, 100%. I think a lot of what you said, resonates with me specifically in terms of how we think about managing risk in terms of our process. A lot of what we talked about from a fundamental standpoint does not influence at all our positioning here at 42 Macro. The only thing that influences our positioning at 42 Macro is what the market's telling me to put on right now. The market is telling me to believe in and have high conviction in the bullish themes because we are in a Goldilocks market regime, according to our market regime nowcasting process. When our market regime nowcasting process tells me to go into a risk-off market regime, that's when the other regime, something like sticky inflation, which would be obviously negative for risk assets, that's when we'll elevate the conviction and downgrade the conviction of the other bullish themes from a fundamental research standpoint. So
and that's how I think you shift the pieces in a big way, right? You shift those pieces in a big way using that type of process and structure. But then in the interim, it's like, well, something super cheap. Well, what can I do with that? That was barbell. Something to this. Well, I'm going to do it, right? And so as long as you're not putting too much money out the door, that oftentimes can be your risk management. It can be your protection. It can for the core that you have. And so that's where I'd say we layer on to this process and thinking about it in that way.
Good. So this has been a phenomenal conversation, Nadine. I'll wrap up with kind of 3, I wouldn't say rapid fire, go as long as you want to go, questions. So first question is, you mentioned something about playing in the sandbox. What percentage of your portfolio would you say you sort of allocate to the sort of sandboxy type themes?
Depends on the client. So some clients love to be involved. And so it could be up to 15% of their book.
Yep.
But in other cases, it might be more like 3 to 5, right? Is that like if they, so that's less about the sandbox we're allowed to have versus what I would let a client be involved with on the family office or individual side. But for us, I'd say it's, there's like a risk budget. So again, it super depends on the client. But if you're talking an institutional long only, you know, we pride ourselves in being different than the benchmark. And so we need to be more attuned to actually your process is making sure we're riding that core for as long as we can. But then it's almost like it depends on the time. Like sometimes we might be super non-consensus and it could be 80% of the portfolio, and other times it might be 5. So a good example of Zach, that might sound crazy, is that, you know, we were telling people about this pandemic, you know, in like January 2020, and we actually bought toilet paper. The only thing I was dumb, I didn't do is like learn how to cut hair then. I should have gotten a haircut. But, you know, we were ready for that. And we had all kinds of positioning on right across just, you know, long only and hedged. But what happens though, is that when everybody gets to your side of the trade, whether you called that in February or March, then you have to get out of it, right? So you have this turnover then of, well, I just got paid on my gold and gold could keep working, but probably not. So now I got to sell my gold to all these people who are rushing for gold. And then I got to go buy Canadian banks, right? Or whatever it is. So you know, the steady state isn't that crazy, but you do come upon these periods where it can happen. And that happened actually the last election when Trump was running. If you remember like tech was way down and defense was way up, and the materials are down. And then I think materials or energy like popped in December. Like, so you had these crazy moves. And so for a client who's absolute return and may have like certain set positions, they can decide to play or not play. But if you're playing against a benchmark, then you can see a ton of this kind of, I'd say, tactical positioning that you would do in a short amount of time. So I think we had the highest turnover in those kind of portfolios around those types of events where you're just getting such extreme positioning. But in most times, you know, it should be a much more managed number because obviously losses can go up in this kind of stuff.
Oh, I love it. The very institutional insights. And
Remember that? Remember that Trump trade? I was actually like across the street from Trump Tower. I remember like global markets were freaking out. It was just, it was insane of just the strong moves that we saw during that election.
Are you talking about the 2020 factor rotation or the 2016?
The 2016, yeah.
2016,
yeah, that was
Oh.
huge, right?
Oh my
so
goodness.
Banks, you're paying banks shot up. Like if you owned the exchanges, they didn't do as well. And so if you had defense, you know, so it's like there were huge winners and losers immediately.
100%. Yeah, in both of those instances, you went from a risk-off market regime in 2016.
Like then it didn't matter, right? Like the regime didn't matter on those days.
Well, no, I have a very strong disagreement with that. We went very hard into reflation as hard as
you did because of who won, right? But like in that moment, like you went from one to the other of expectations, right?
Yeah,
but
overnight.
It didn't matter that day what you were in. It was like, where are you headed? And it was like a repricing of everything and reshifting
100%.
of exposures.
100%. Yeah, totally. And I say this all the time. It's, you know, if you think about this, just managing risk as an investor, as an institutional capital allocator, there's really 4 big cycles that you have to get right. There's growth, there's inflation, there's policy, and liquidity. Yeah. And the positioning cycle comes on and it acts as an accelerant when one of those cycles inflects. If you're kind of at an extreme in one of those cycles and the positioning is at an extreme associated with the legacy theme, boy,
yeah.
that trade,
on
the right side of it. 100%. 100%.
And you might be a winner. Like you might get lucky and be like, oh, but don't think you're smart. You just got lucky at that point, right? You played an open the envelope event there and got it right.
100%. Yeah, 100%. And then last and my final trade is, you know, I've heard a lot of sort of how you're thinking about kind of the various tails in your themes, your portfolio. Yeah. What's the biggest position you have right now? What's your core of your portfolio, your clients' portfolios? What do you have the most conviction in right now?
That's a good, you know, again, it depends on what we're playing. Like if we're playing against a benchmark, does it include EM or not? But we did have EM even in DM portfolios just because of the massive underweight. One of those like, gosh, if anything goes right or the hint of anything goes right, And then also, I'll tell you this is, obviously India had outperformed, but guess what happens if China is real? Money's going to get pulled from India and other places that had
Totally.
relatively outperformed. So
Totally.
one thing I'd say is that, not to say that that's like the biggest conviction we have, but it's looking to positions outside the U.S., not just for the dollar reason, but more for, it's been so U.S. centric and tech centric that, what else is out there? I talked a little bit about energy and materials being a bit non-consensus of where we've been. And then, some of the things that we're looking at is a little bit more of the short-term trades for tax-efficient portfolios. And so I won't go into too much, but we have a pretty good mousetrap on enabling that to happen because of the passive flow phenomenon and the technical trading phenomenon. So we're actually creating a portfolio that's going to, I think, launch in like a week that's just based on that. And so that for that portfolio is like 100%, right? But that'll be a small part of other portfolios too. So again, we never go like, well, that's not, in the current situation, because there's some open the envelope risk, it's much more about what's not being priced in and what can we do with that.
I love it. I love how you run your structure your business. It's very bespoke. It sounds like you sort of
It
create
is. You
solutions for
can't
each of
do
your
it
clients.
otherwise. Yeah, you can't
Yeah.
because like now someone might have a different risk profile. And a lot of people have legacy positions that you can't get out of for tax reasons. And so it's really nice to say, well, this is my new framework and I'd love to get rid of all this and buy this. But the practicality that most of us play in for, taxable accounts is you can't do that. So then you are required to be a very good practitioner to come up with, well, then what do I do with, like, let's say you had a ton of Novo Nordisk and you thought it was like overvalued or gonna have issues. Then what do I do with that? If do I need to sell and hit someone a tax bill, or can I manage that somehow?
I love it. Nadine, where can we send people? And you guys are,
Sure.
you'd be
We're
fools
everywhere.
not to
No,
go chase down Nadine because she has a lot
sure.
of solutions for a lot of
Yeah, best
really
thing
high
to do is
institutional
don't
clients.
call me. Electronics always good. I'm on LinkedIn, and a lot of people do contact me there, but you can contact us through solsteincapital.com. And we have some fun podcasts that are out and then also coming up here that we're going to be releasing. In fact, I'm doing flying cars tomorrow with the number 12 employee of Tesla originally, who now is doing flying cars. So we have lots of cool things on the Just Think About It with Nadine and Ben. So you can, if you're interested in going deep into totally random topics, that's you can find us there too.
Well, I'm excited. Hopefully some folks come look you up after this. This has
All
been an
right.
awesome conversation. Always a pleasure.
You
Looking
too,
forward to
Darius.
next time we connect. So I appreciate you guys, and we'll catch you back here, everyone, next month. I want to say off the top of my head, we have our friend Bob Elliott over at Unlimited Funds to come give us a fantastic update on what's happening in the U.S. and global economy. So stay tuned for that next month. Everyone have a wonderful month out there. We'll catch you back here next time. Cheers.